Devina, as always, ladies first. Do you think alpha is dead in the Indian markets now? Or do you think that, given everything, generally they say like there's a signal to noise ratio and there's a lot of noise in the market right now. So if you had to give us the big signal that you're looking at, what would it be?
I think nobody knows exactly where the bottom is, but of course, my advice has been that A, never have 100% in equity, and B, most of the time, whatever is your equity allocation, remain invested in it, because equity should be money you don't need for 7 to 8 years. So this is the whole problem that, in theory, if I ask everybody, they will say, yes, the most volatile asset class in the world is equity, but when you're living through the volatility, it seems it is something unprecedented, and, how will this ever end? That's how it appears. Yeah, in terms of alpha, they're always, in normal markets, at least about 40% of the stocks outperform, that's the data. Last year was very unusual. It was a very narrow market. So at one point, there were only about 12 or 15% of the stocks outperforming, which is why for 2025, even though the indices were up, the average stock was down, and 40% of the stocks were down more than 10%, which is why the pain in the portfolios was not quite captured by the indexes. Now the market is broader, so that's one positive, that again you see many more stocks outperforming. In general, I would say don't believe anybody who tells you they have the magic formula for multi-baggers. So always spread your bets, always diversify. And I'll give you a very simple example as to, diversification is not magic that 50 stocks is better than 15 stocks. All diversification does is that in a game of luck and skill, and investing, like most things in life, is a combination of luck and skill, increases the proportion of skill and reduces the proportion of luck. That's all diversification does. Like if you toss a coin, if you toss it 10 times, you might get 7 heads or even 9 heads. But if you toss it 100 times, you are likely to be close to 50-50. So if your stock picking skill is that you are right maybe 60% of the time, 65% of the time, which is actually a very good ratio, then in actual results, you will get something like that. So do the boring stuff right and don't try to optimize. So that would be my first advice. So get the asset allocation, go beyond India also, not just in multiple assets, which I'll be talking about in the afternoon. But that would be my broad recommendation.
Okay, so I also want to talk to you about that, because you've been advocating global investing for very, very long, and now there is so much FOMO around global investing. But since you spoke about direct stocks versus... Yeah,
I went global in 1999. Nobody had dreamt of it then.
A fair point. And now there's a scramble, right, to get to global investing. But it's perhaps justified given the way most global markets have moved. But let's try and get a show of hands here. Since you spoke about direct stocks, and we have here mutual fund managers, we have PMS managers, we have global investors. So let me get a show of hands. How many of you in the audience do direct stock investing? Okay. And how many of you have lost money? Vikas is saying everybody has lost money. Not too many actually, not bad. And how many are mutual fund investors only? Just mutual funds? Wow, there's like hardly any.
Lot of potential. Yeah.
Kalpin, what is going on? There's hardly any mutual fund investors. So mutual fund and stocks.
Only because, see, the thing is everybody thinks that they are better than average. If you ask in driving also, I think 80% of the people will say I'm above average driver, which is statistically impossible. So everybody thinks they can do it.
Okay, fair enough. Yeah, that's true actually. That is true.
Just to add to what Kalpen said, he talked about mutual funds performing for or whatever kind of fund performing. I'll just give you this statistic. Again, one book which many people will have on their shelves at least is Peter Lynch's One Up on Wall Street. Now, the fund that he managed for Fidelity was, I think, the best performing mutual fund of all time in the US. It compounded something like 28-29%. But the average investor in the fund compounded only 7%, and a good percentage of them lost money. Lost money in the best performing mutual fund in history, because they entered and exited at the wrong time. Because typically they entered after a big outperformance, and then the next year there was a huge underperformance and they exited. Okay. So this is like a one-line post I have posted multiple times on social media, that one truth in markets, that themes change. asset classes, countries, even investment styles go in and out of fashion. So,
Got it. No, fair enough. 100% agree with you.
see, I mean, you can pick an end point and show anything. Let me tell you, from 2010-11 onwards, for a whole decade, India in rupee terms compounded only 8.8%, which was more or less fixed deposit returns. In dollar terms, it hardly gave any returns. I think it was a 1% compounding or something. So, so global, I totally agree that you should not look at what has performed of late and jump there. In fact, we actually did an exercise that if you systematically invest in what has done well in the past 1 year, you will equally systematically underperform. It is the worst way you can do it. Manufacturing, though, Sonia, as a percentage of GDP, is at an all-time low. Manufacturing in India as a percentage of GDP is where it was in the 1960s. It is in the 13% range. It was 17 and a half from about 2009 onwards for 5-6 years. It was in that range, and it has just been falling since then. I mean, that's an aside, because markets and industrial data are two different things, but that is really the data.
A quick point from your end. He said that 1993 to 2003 was a period where we saw absolutely no returns, and actually it caused a lot of trauma for a lot of people, because every panel discussion people remember that 1 decade of no returns. So you think we are in a situation like that where it could be a very long drawn, painful, no return kind of situation for India?
In fact,
So
the
just
sequel
one
to
point.
the 2003, the 9-year period without return was that in the next 4.5 years, the index went up 6 times.
Yeah.
So, that is what is meant by equities are volatile. It is not that 1 year you will get 25% return and the next year you will get 12% return. The next year you might get minus 30% also. Yeah. That is what is meant by equity being volatile. And also remember, the NASDAQ high of 2000 was not taken out for 15 long years. It took 15 years to recover to that NASDAQ index. I mean, we think the whole world has always been driven by the US market. So, always look at data, and don't drive looking in the
Rearview
facing
mirror.
backwards.
Yeah. Okay, I'm going to come to you guys. I want to take some questions before we end, and many hands up there. Okay, let's take the one lady right here in the front first. If someone can just hand over a mic to her.
Thank you. My name is Deepika Kapadia. I'm an early Amazon employee, and just learning to invest for myself. My question to this esteemed panel is, if you strip away the emotion of investing in India versus outside of India, if you strip away FOMO also, because it's bad to chase something that's already at the peak, can we look at first principles and talk about, for today's world where there is a tech revolution, where there is perhaps some lack of disruption in the Indian corporate world, but still it's a glorious economy with a lot of promise. If you just looked at first principles, step back, how does one invest today versus just emulating what we've done in the past?
Okay, I mean, first of all, if you look at first principles, India is less than 3% of world market cap. There is no objective, rational reason why 90 or 100% of your investment should be there. I mean, that, and plus the other fact is that you're already exposed to the Indian economy. You are already have your job here, your whole life here. So if anything goes wrong, you're already exposed. So, I mean, logically, you should be invested a lot more globally. But at the very least, over a period of time, get 30-40% global. And this is not something I've been saying in the last 6 months. I've been saying exactly the same thing for years. As I said, I realized it in 1998. I went global in 1999. After the Asian crisis, ये समझ में आ गया कि being in a single country can be very risky. So that's if you first principles, that is the thing. It might sound very radical, but if you look at first principles, your majority of investment should be overseas.